Perfect.
Will we get this going? How have you been?
I've been doing great. It's a lovely Tuesday. Excited to chat.
Love it. Let's see. Great. We got people coming in. We'll get started in a second here. All right. Where's everyone from? Shout out where you're from. Let's see where we got. We usually can hit all continents. Maybe not Antarctica, but we'll see. Mexico. Love it. Do you guys operate Pulley? Can Pulley be used by companies outside the States, or do you have to be like a Delaware C Corp or incorporated in the States?
No, the great thing about Capital Equity is numbers are numbers. So even if you're outside the States, you can also use Pulley.
There we go.
It's fun.
Where else is everyone from? Philadelphia.
We have different time zones that's on this call.
Brazil, Canada, Atlanta, Toronto, India. There we go. Love it. I'm gonna get my screen going here. All right, share. Wait, presenter view. Great. We're gonna give it one more minute here. This will be recorded. I know that question comes up, so I'll do that again. But Yin, you ready to jump in?
Let's do it.
All right, love it. So really excited to chat today with Yin. She is the founder and CEO of Pulley. She's actually on the first season of the Founders Forward podcast, so excited to have her back for this webinar series we're doing. Yin's a multi-time founder. Is this your fourth company?
This is my fourth company. I've kind of lost track after a bit.
Yeah, there we go. So we call it multi-time founder. Her most recent company acquired by Microsoft, and now is helping founders with cap table, raising money and managing that all online. For those of you that I don't know, my name is Mike Cruz. I'm the founder of Visible. We help companies update their investors, track KPIs, and manage a fundraising all in one place. Let me get, sorry, Google Slides always trips me up here. Real quick, and we'll circle back on this at the end too. If anyone wants to use Visible, please do so. You can use the promo code Pulley690 and you'll be able to get 90% off your first 6 months with us. And then Pulley, I think we have a perk with you guys too, to get 25% off your first year. Any idea on how to redeem that? If not, we'll update the deck when we send it out.
Let's update the deck and then we'll get you that code too.
Yeah, okay, cool. There's instructions to redeem. I know we've referred a couple people to Pulley already, which has been awesome, and vice versa. So today we're going to cover just some awesome stuff around fundraising, why founders should understand the power law. We're going to kick things off with that. I think it's going to be super helpful to frame power law in the mind of investors with fundraising. We'll jump over to what safes are, best practices for safe, how to most effectively use them. Determining how much to raise, weighing dilution versus additional capital, right? If I can raise more right now, should I, or should I wait? Determining your valuation early on, and then we'll get into some nitty-gritty 409A valuation work as well. If you have any questions, please feel free to use chat. You can email Matt at visible.vc. He'll be monitoring his email, as well as #VisibleWebinars on Twitter. And if we don't get time to get your question, we always try to at least get back to you through email if it's something super specific or we run out of time. So, before we jump in, just, framing this of why, maybe you should care as a founder and how hopefully this can be useful for all of you. One is investors are seeing a lot of deals. Fundraising is a very asymmetric experience. As a founder, you're only doing it a handful of times in the life cycle of your company or companies in Yin's case. And they're doing it every single day for decades. So it's a very asymmetrical experience. Every stage, that you are fundraising, there's always dynamics at play that are going to affect later rounds, and things like dilution also impact a lot, right? And then finally, maintaining control of your company. We're going to talk about what that looks like, how you should think about your own dilution as you raise more capital, and what good looks like. And the first thing, we've been really diving into this at Visible recently, is who should even raise venture capital, or why you should raise venture capital. And I think it's always helpful to frame yourself as a founder to understand the rules of the game and the rules that investors are playing by with their LPs and their investors. And I think, really one of the big things that founders need to do is understand power law as it relates to venture returns. And there's some interesting data. And by the way, when we send this deck out, you can click any of these links to view the source. But Ben Evans wrote that 6% of startups make 60% of the returns. And venture fund investors, LPs, can put their money to work anywhere. They can put it into public equities, bonds, real estate, et cetera. When I'm putting it into venture, I'm expecting a different return and diversification. And so, if I can't get my money out because I'm putting it into venture, which is highly illiquid, I'm going to expect a higher return. So just some quick math, just for founders. If I have a hypothetical $100 million venture fund, and let's just say I own 10% of, that's amazing, at exit of all of my companies, that means I need all of my portfolio companies to exit between $3 and $5 billion, times that by 10% to get a 3 to 5x return, which is kind of what good looks like. And so it's really important to understand, why this matters, because I think the takeaway here is venture needs big exits that operate in huge markets. So you really need to, one of the things that you need to do at Center is convey how you can get traction in the market, but the bigger version of that. And then Ahmad from Mercury had some pretty interesting takes recently that we screen captured here. But before, you could, if you're raising a $2 million valuation, a single unicorn might make a fund. But with all of the different funding announcements today at higher caps and higher valuations, those exits need to be even bigger. Like unicorns, theoretically, quote unquote, don't even matter anymore. So that's pretty interesting. Yin, you've done this multiple times. Yeah. I'm just curious, I would love to get your takes on market sizing and how should founders think about pitching a huge market? But I think it's always a balance, right? You can pitch a big market and vision, but rubber meets the road, execution and initial market. What are some things that you're seeing or any advice that you have?
I think this tweet is just very much spot on. When we talk to a lot of founders, one of the common mistakes we almost see first-time founders make is worry too much about the downside. If you're creating a venture-backed business and things are going well, very much your investors are hoping that you're going to do 100x, 1000x from where you are today. And there's actually also a really big tweet by Mac McGinnis, who's the CEO at Rippling, who's mentioned if companies going out of business is part of the business model when it comes to venture-backed companies. I think your slide just earlier, one back, was talking about how a lot of these companies are going to fail, but the way the venture math works is that you have 1 or 2 decacorns that really make up the fund. And we've seen valuations in the last year starting to change. Companies that used to be raising at $10 million seed valuations is now bumped up to 30 million. You see Series A's that are in the hundreds. It used to be the case that if you're a SaaS company, I would say 30 to 40x ARR is considered a really good multiple. Now what you're seeing is 1 to 200x. And the reason we think that we're starting to see some of these outlier valuations is that I think all of these markets have become so much bigger than what people expect. When you see companies like Robinhood that are now worth 40 to 50 billion, when you see companies IPO in a lot of these spaces and realize that software is kind of taking over all these markets, I think investors are also looking to invest in more of these companies and hoping to use a higher valuation to get an edge too.
That was awesome. Should you think about, let's say you have kind of 2 options as a founder, more dilution, more higher valuation, right? Because maybe they're putting more money into the company versus less dilution, but maybe lower valuation. Is there a preferred? Yeah. Do you think there's a preferred route there, or is it kind of up to the founder and maybe the investor you're working with?
I feel like it really kind of depends on what's the company that you need to build. In order to answer that question, I almost go back to first principles and think So the goal of raising funding at a certain stage is that you can hire so that you can scale growth. You can do something so you can hit your next fundraising round. There's metrics that you want to hit. Before you raise a round, I would take a look at, great, like what do I actually need in terms of hiring and a team and in terms of resources and able to hit the goals that you set when you fundraise for this round. You have capital intensive businesses like Boom Supersonic is a company that I've invested in. It's literally making a supersonic plane. Its biggest risk is, can it raise enough funding to get to the next round? So they're going to have to take more dilution. Then there's also other companies where it's like if you're more of a software only SaaS company, the cost of you building the product is just much less. So I think for those companies, if you can have the option of taking on less solution and more, that's a great option too.
That was interesting. Your take on, founders thinking big, swinging big, and less about downside. But do you think that, like, if I am maybe going and raising a seed round at a $20 or $30 million cap, and the market self-corrects and I haven't hit the milestones to go raise the next round, am I potentially hurting myself with a down round, or should I just raise at the valuations that the market's dictating today?
I think it's almost impossible to answer that, because I almost think about, like, what's the framework that you use for answering that. We went through YC in the winter 20 bash, and this was right before COVID hit, or right around the same time. So it was a roller coaster where when COVID hit, I think the public markets tanked. So then a lot of venture investors took a step back or paused investing because they weren't sure how the markets would self-correct and needed to focus most of their time on their existing portfolios. But then what you saw in 2021 is that, like, not only have the public markets rebounded, but venture funding is like shot to all-time highs. So it quickly returned. As a founder, the way I would think about it is, how do you operate your team so that how do you kind of operate your company so that you're not just dependent on the next round in order to stay alive, because markets can shift really quickly. And I think getting to profitability is still something that's really important. At the same time, how do you think about the capital you can raise as an accelerant? Today, it feels like we're in a very capital rich environment. If we're in a capital rich environment and you're able to raise funding at less dilution than what you would otherwise, and you think that you can actually use that funding well, then I think it's a great time to raise. Like, the last point I would almost add is, like, but I think to your point of, like, what companies should even raise funding, when you take venture funding, you're signing up to be a high growth company, because that's the definition of a startup. You have to grow really quickly. Like, if your goal is to hire slowly, get to profitability, that's amazing. Like, you can be you can do that and grow in a phenomenal business, but that may mean that venture investors are signing up for kind of a different return profile, and that funding source is not necessarily the best option.
Yeah, awesome. We talked about market sizing. It's in how big markets really are. I thought this was kind of funny. It's incredibly hard. I grabbed this from Uber's original pitch deck. They had the market size of the taxi business. This is, I think, 2009 or 10 with this. It's like 4.2 billion. And their best case scenario, right? They're like, their best case scenario was market leader, billion in annual revenue. And I think 2020 net revenue was 11 billion. So, like, 10 times bigger than what they even thought their best case scenario was for an outcome. So I thought that's pretty funny.
Actually, sorry, like, just maybe going back to that slide, I feel like we've seen this repeatedly. There's so many companies today that are like, I mean, taking Boom as an example, who would have thought that just like screen sharing will be as big of a business as it is today? They do one thing really well. We're on Zoom. I think when Zoom started, it was, well, there's Google Meets, there's a ton of other services. Why would Zoom be as big as it is? And turns out it's actually a massive business. I actually feel like picking the right market, and I think this is one of the things that investors oftentimes, like, the too much experience gets in the way, because you're looking at the way that the world exists today rather than what do you think the future of the world could be. And I feel like the best opportunities for founders and for startups is, you can't pick an obviously large market today, because the obviously large markets, everyone else is going after them. The big companies with resources are going after. It's really hard for you to get the edge. The places where we see startups really excel is, like, they're taking after a market. Uber has a great example that nobody thought was that big, because taxis is only $10 billion. How much percentage can you get of a taxi industry? But if you have a really good product, you can execute well, you can also create and expand the market. Because for Uber, it's no longer just how big is the taxi market, but more, what's the size of the transportation market? What's the size of car and buying cars? Yeah.
Yeah, it's wild. I don't even remember. I can't remember the name. It escapes me. But Snowflake, recently went public, had a huge IPO. One of their competitors is staying private a little bit longer, but like the combined market cap of those two companies, I think is already like $150 billion for data warehousing. So pretty insane. We have a TAM template. Just you can download it and use it. Kind of plug in some where you think the market's going and price points and all that, and we'll give you and spit out a kind of a sensitivity analysis of like what price points you need to be at for certain annual revenue rates. So make sure to check that out. But let's get back to, that was awesome talking about market sizing and vision. I love that stuff. But getting to safes now. And I think this is where Yin and Pulley, you guys are just like the knowledge experts here. And so some of the stuff might be basic for some of you, hopefully not. But like, first question is like, what is a safe? And I'll just pause there.
Yeah, so a safe is it's basically an agreement where you're going to give, what a safe stands for is security for future equity. So you're not giving equity to investors today, but that there's a standard agreement that you are giving to investors that say in the future, when we raise a round, you can convert the safe into equity. So why does that even matter? The reason it matters for you is that for companies raising today is like prior to the safe, when companies would raise on an equity round, it would take months and thousands of dollars working with a lawyer in order to close funding. You're a startup. The biggest advantage that you actually have is being able to move quickly. If you're taking funding in order to close funding, that's not a really good use of resources. And it's also not a great use of your time. So what YC did was come out with this safe instrument that's just standardized across many companies that's doing seed stage funding, to say like the only terms that you need to figure out is how much do you actually want to invest and what is the valuation. And with those two terms, exactly the principal and the valuation cap, you can go and raise funding. What we often advise companies on when it comes to safes is use the standard that's already been created rather than trying to get creative and using anything else. The safe is used by thousands of startups, and I think in a good way, it's become kind of the de facto way to raise at the seed stage. It's the fastest way to raise. It's both beneficial, I think, fair to investors as well as founders, and it just allows companies to focus on growing their company rather than like fighting over the nitty-gritties.
Yeah. What's the difference between you hear pre and post money safe? What's the difference? And I even think recently I saw YC might have even been taking down the pre-money safe from their templates online and is only doing post money now, from what I saw. I haven't checked that myself, but I saw a tweet about that.
So the difference between pre and post money safe is the way that the safes convert when it comes to an equity round. So your equity round is typically a Series A. So your first round that you're actually giving shares to investors. The post money safe dilutes investors as well as founders differently. But the benefit of post money safe is it's very easy to calculate your dilution. So if you raise $1 million at a $10 million valuation of post money safe, what that means is you've given away 10% of your company. I think the key thing to keep in mind, especially when you're raising money in safes, is that you are giving away equity, and it's really critical to track this so that founders don't give away too much equity even before you raise your next round of funding. I think standard rule of thumb is that when you're first starting on the seed stage, giving away 20% of your company is kind of a good metric. At the Series A, you may want to give away another 20%, but then in each subsequent round of funding, you actually should take less dilution. And the reason for that is like now your company is lower risk. Now you should have figured out like, how do we get distribution? How do we, what's our CAC and all of those things, so that you're only taking funding to really scale at kind of the Series C and D stages.
What? Yeah, that's super helpful. What about like safes on safes? Because I think that's common now, even too. Like anything founders, common mistakes you might see that we should look out for, or traps if I'm using a safe and then I use another safe.
So I think that one of the terms that I actually really call out is pro-rata. We've seen a lot of founders actually not really understand what the impact of pro-rata is. So what pro-rata is that it gives the investors the right to be able to invest more funding at your next round in order to keep their ownership stake. So on one hand, you could say like, oh, that sounds great. Like, I think the way that an investor would often sell pro-rata is like, great, when you raise your next round, like 10% of the funding is already guaranteed by me. But the flip side of how you would actually take pro-rata is that means even an investor, if your company is doing really well, you're not going to have a shortage of investors. So what pro-rata does is actually locks up a portion of your future investment to investors that you promised pro-rata for. For us, like the advice that we want to give is like, I think it's actually really important to align incentives. You want to have investors that have been helping you with your last round, invest more in your future round. So if you can, try to negotiate with a pro rata. But I think for a lot of these things, it really depends on kind of what your negotiation position is. Like if you're a startup with a lot of investors interested in investing, then you can negotiate the best terms. You can negotiate a high valuation. You can remove pro rata. If it's the case in which you don't have as many investors currently interested, and that's fine. There's a lot of really good companies that investors didn't get until later rounds. Then it's harder for you to negotiate some of these terms. So to your earlier questions, like stacking safes on safes on safes, I think the key thing to figure out is how do you actually model this? Sure. Using a tool like Pulley to track, like, great. So if I'm raising on all of these safes with different valuations, this is how much of the company have actually given away. You should always be able to answer the question of how much of the company do I actually still own today? Don't be surprised by that, because if you're surprised by that, then that means the future rounds of funding could be really hard for you to raise because you've already received so much dilution in the past.
Yeah, some great questions coming in. Let's just get to some of these now. So Darius wrote in, I think this is a great question because for the longest time, I think convertible notes were kind of the de facto tool for late stage companies. So what's the difference between a convertible note and a safe?
One of the big difference between convertible note and safes is actually the interest. So convertible notes technically charge interest that you're supposed to pay. We've seen like different approaches. So for Silicon Valley investors, very rarely do they actually collect on the interest, but technically you're obligated to pay on the interest with convertible note. But what we've seen is like investors in Europe or in the East Coast, they sometimes actually do collect on the interest. The safes do not collect interest. They just exchange into equity. That is the only thing. Like technically with a note, the reason that YC created the safe was like technically with a note, if your company shuts down, the investors can go after your company to be able to collect the interest on it. Rarely professional investors do that though.
Yeah, and I've seen that play out now where I saw a founder who raised on a convertible note and it's accruing interest, right, for the conversion. This was, maybe 8-9 years ago. They went to profitability, haven't raised since, and now the interest is actually higher than the principal of the actual investment. And it's like really screwing things up if they ever want to go and sell for more, right? Because now you're really under, like, every single day your ownership is actually going down.
Exactly. Yeah.
Which is wild.
So it's like compounding interest works both ways. It's if you do something positive, then great, it compounds positively, but also negatively. So
what if I'm a bootstrap company? Should I care about valuations and cap table and use Pulley if it's just me and some founders and like a couple of employees?
So the thing I would say there is like, if you're a bootstrap company and you plan to give equity to your employees, then yes, absolutely. Using a tool like Pulley makes it far easier for you to manage equity to employees. So a cap table a cap table is kind of cap table simply is basically like a list of who owns what within your company, how many shares, and what's their percentage ownership. That sounds really simple to track. And it is fairly easy to track when you're like 2 to 3 founders. What becomes more complicated is when the company scales. Even when you have 10 people and they all have options and some people want to exercise their options, how do you actually do that? Are you taking a paper check? Like, how do you give them shares? A tool like Pulley with cap table management just makes that process a lot easier. And I think the other part is that investors today often want to know when you're fundraising, like how much of the company do you own? How much have you already given away? They care about that because they want to know, like many times, especially at the early stage, they're really betting on the founding team and particularly most of you on this call, they're taking a bet on you and they want to know that you're actually motivated to stay with the company for the long term. So using a tool like Pulley can also kind of help you figure out like, great, this is how much this is how much of the company I still own. When I think about future fundraising rounds, this is how much we can give away. Like when we say bootstrap company, we've also seen like different versions. Sometimes you've done like a friends and family round. If you've done that, technically you still have investors because they own a portion of your company.
Yeah, I'll echo that. Visible has become a profitable business that's growing, and we use Pulley, and it was just amazing. Like we hired some new folks, got approved by the board, and it was like super simple to just like go in, option or give everyone the option contracts out and sent. So like, even if you're a company similar to Visible, I would like highly recommend it. It's super awesome. All right, let's get into determining how much to raise. I think even some questions coming through now around like valuation and raising, and those two things kind of work hand in hand. And so you always hear founders like, oh, and we talked about this earlier, like use of funds and things like that. I would love to just get your take on how to think about goals and what you want to establish, and like how much I should raise. And maybe let's just use like a pre-seed or seed round here in this example. I think a lot of early stage founders on this call, like, what should I be thinking about in terms of how much I should raise?
And this is such a great slide because I think you've actually exactly outlined it. Start with your goals and work backwards. What are your goals? Like if your goal is to be able to build the MVP, then you need to hire engineers or you need to contract it out. What's the cost of hiring engineers? Estimate $200K per engineer if they're based in the Valley, maybe less if they're based elsewhere. Great. So then figure out how long would it take to actually build a market and to build your product. And I think that's how you end up determining how much do you actually need to raise. I think actually like one of the things that I actually call out is like, I feel like one of the big differences between second and first time founders is first time founders focus a lot on like, how do you build a product? And second time founders focus on how do you actually get distribution? So I think your second point of like, how many engineers, how many salespeople, what about marketing? All of these are really critical. It's not just if you build it, they will come. You need to figure out how are you actually going to get distribution for your product. And then I would also say kind of the last point is like, this question of like, if you hire like 3 engineers versus 6 engineers, the question is ultimately asking like, how quickly do you want to move? And I think how quickly you want to move is like correlated to how confident you are that what you have is working. So if you're less confident because you're just starting out, don't expend as much resources. This is a place where I think you and your investors can differ. Investors are going to push you to spend as funding quicker because for them, they want to bet on the next unicorn. So think about the first slide that Mike had, which shows like investors want to bet on the next unicorn. To get to the next unicorn, they want to invest all of their companies to spend funding quicker to get there. But for you as a company, this is your only company. You don't have a portfolio of companies. So I guess like not hiring in advance of like your confidence in the product and your growth rate, I think is also important.
How much, let's say I'm a second time founder in this example, and I kind of distribution matters, et cetera. How should I think about like how much wiggle room do I need, right? If I'm not executing perfectly for whatever reason, like should I give myself, and knowing the next round will take time, should I give myself like, yeah, I think the plan is 12 months. It'll take us 12 months, but should I raise for like 24? Like how much wiggle room should I give myself?
So assume that it's going to take you at least 3 months to fundraise. So then I like to give at least like 6 months to a year. And that could be maybe more on the conservative side. I think as a company, you're always like, for me, I think Gates has this line is like only the paranoid survive, or maybe that's Andy something from Intel. Yeah. Where it's like, I'm always paranoid about like, are the markets going to change? Is something going to be different? Like knowing that you always have like 6 months, a year of runway, I think is really key. It's even the case, like even if you're a profitable business, that's not guaranteed. There's so many profitable travel businesses that when COVID hit, like really tanked. So do as much planning as you can in advance, give yourself that flexibility. And at the same time, like you're a founder because you can respond to chaos. You can respond to changing markets. Assume that you're also going to figure it out along the way too.
Yeah. And especially thinking about sales, by the way, I always like to think about ramp in time when you're hiring sales folks, because when you switch from founder sales and you're selling the product and you know better than anyone and you're passionate about it, to like giving that up and hiring your first salespeople, if you are, have a sales component to your business, I always like to make sure you're including things like ramp, because it's going to take those people to get to time, to quota attainment and some things like that. So that's just like another tip, is always like, it's going to take you longer than you think, and your first sales hires are not going to be as effective as you are selling. That's not a bad thing. Just a reality. So always make sure to model that in as well.
Absolutely. And I think hiring is what is actually going to define your business. Like,
Mhm.
so if there's a lot of like engineers or product founders on this call, I think it's a case that you're never going to stop selling. You're going to be selling when you're raising, you're going to be selling to close people. I actually think it's even harder to sell to close good candidates because it's such a hot market today. They can work anywhere. So there's a question of why should they work with you and invest in their time, which is even more of a scarce resource than funding. So the being able to close really good people is difficult. So like at least 2 to 3x the time that you expect it'll take to hire.
Yeah, well said. Let's get into a little bit of dilution, and we talked about this a little bit already. Versus raising additional capital. There's some adage out there that like fundraising is compared to a cocktail party. Like when the hors d'oeuvres come around, you should always take one because you don't know when they're going to come around again. And fundraising is, time and time, you said it's going to take you 3 months. How should I weigh, and then, there's no right or wrong answer as we talked about, but like, how should I weigh thinking about getting more dilutive, more money now, maybe extends my runway versus like protecting my ownership and, maybe hitting milestones and raising later on. I think this is something a lot of founders are maybe even thinking through right now. Like, I was just talking to a founder the other day who's like, hey, we got this awesome term sheet from one of our current investors who preempted the round. But we think we can get to $1 million in ARR later this year. Should we wait? So like, how do you think about this? I'm sure this might even be happening with you guys right now at Pulley.
Yeah, so I asked kind of 2 questions is like, how much dilution, what are the terms? So what are the terms of us raising that we can get today? And the second question is, what do we, I also wonder, like, what do we get other than capital? So if there's an investor that we really want to work with that we think can help us hire more great people, that can help us that understand the domain well, do we want to bring them on board and make them a vested player in Pulley? And I think to the first question of like, what are the terms? What you're trading off, I would say, with your question is like the ease of fundraising today on certainty and the less dilution, potentially less dilution, but also potentially like a longer time to fundraise, but then you also kind of get better terms. I think it's really tough to answer, and I think it's the case, like my view on this is typically like you're going to be able to likely get better terms if you wait to fundraise and run a process. It's like an auction. If there's more buyers at the table, you can probably increase the prices. But what you're giving off is just really time for you to run that process, and whether that's worth it.
There we go. I think that's super smart. Valuation. I think we talked about some valuation earlier, actually, some Q&A. So just visiting here. Especially in the early days, right? We're betting on team more than anything in founders. Things like safes, have helped here too. But like, how should I think about? And maybe I'm not a Bay Area company, right? I think we had a lot of people from all over that
right.
we heard that maybe not in Bay Area. So like, how should I think about benchmarking my valuation in the early days? Any good resources for me to maybe check out about this? Because I likely had little revenue. And really it's when people are here like, oh my god, they raised it like a $20 million valuation, that might not be insane, right? Because this is all supply and demand based. So how should I think about this, for when I'm starting my company?
Yeah, especially for the first few rounds, it's all about future growth. It's all about the promise of the market, how quickly it's going to grow, and the promise of your team to be able to execute on that. And I would also say, like, the more traction you have, the easier it is to fundraise. And traction comes in all forms. It doesn't have to be like revenue. It can be number of people that's on a wait list looking to try your product, LOIs that you have, like pre even building the product. All of this, I think, is a really good sign of, is really good kind of traction metrics to show to investors to get them interested. The thing that I think that's like it's such a good question to ask. And it's also a really tough one to answer. Like, what should your valuation be when all you have is kind of this promise of what the future could be? So in terms of benchmarking, what I would advise is look at companies in your space, TechCrunch, Crunchbase, all of us that have data of like, what are some recent, what's the valuation of other companies that you think are similar to you, so that you can take a look at what they've raised on. And then I would also say the second thing is like, if you do know anyone that's in the venture space, that's a friend that you can ask, like, it's often good to run it by them. Like, hey, I'm thinking about raising X and X valuation. What's your thoughts on this? One of the pro tips I would throw out is that oftentimes the valuation I've seen for investors matters less than the ownership percentage. Like they want to own 20% of your round. So there's two needles that you can move. They can put in more funding. If they put in more funding, then you also get a higher valuation at the same ownership percentage. So oftentimes what you're actually going to be negotiating with investors is like, what is their ownership? Because that really determines their upside too.
Yeah, Harry Hurst from Pipe, who's one of our customers, has this awesome like tweet based on this, which is like, you could say, hey, we're raising between X and Y at an X and Y valuation. And then that gives you a really big range in terms of like valuation, right? Kind of because now you're playing with those two numbers. I wrote this question down ahead of time and it's coming in. I think, I'm a first-time founder, maybe raising from some angels or close friends of mine. Do I need like a lead to do a save? You hear about someone needing a lead, or is this something I can do myself and maybe just set my terms? I'm like, hey, I've seen comparable companies that are pre-seed, they're raising at, call it an $8 million post-money valuation. Like, can I set those terms myself and just like taking checks today?
Yeah, no, I think you can do anything. It's your company. Like there's no set rules when it comes to fundraising. It used to be the case that companies would have a lead. So a lead investor is the one that puts in like the large check. Maybe like 50, 60, 70% of your round. And what you would do is like, after the terms are set, you go back to the other small investors and say like, great, here are the terms. Do you want to participate? And then they come in. You don't need, I think, a lead investor today. We've seen more and more rounds where you have like 100K checks from a few investors and they all participate. So the answer is no, but I think that some investors still ask for a lead. And I think there's two reasons they still ask for it. One is they don't know how to value the company. So they're looking at someone else to set that value. And I think the second reason is also they want to make sure that you can actually raise the round. So there's certain businesses where like, great, like if you only raise 100K and your goal was to raise $1 million, you can't survive for a year. So then it's like, great, do I actually, my putting in like that 100K is contingent on you actually raising the remaining 900K. So I think that's also a reason why investors often ask for a lead. And actually like maybe to that click on fundraising is like, I think from a tactics perspective, what I would recommend to companies when they're raising is like under promise and then over deliver. So like saying that if you're very confident that you can raise say 500-600K, great. Just say that you're going to raise like 20% less than that. So that when you can go back to investors and say like, hey, we only plan to raise like 500K, but we got so much interest, we're oversubscribed. We're going to increase the amount that we're going to raise to $1 million. That's far better from a strategic perspective to say like, we're going to raise 2 million and then only get to $1 million. Because then from investors, it's like you undershot what you were able to deliver on. And then kind of another question we've also been asked is like, well, what about valuation? Can you give different investors different valuations? I think for that is like, yes, you can. And the way that I think is a fair way to do it is that the valuation is proportional to when the investors took a bet on you. Like remember, riskiest, if they're the first investor to say, yes, I want to take a bet on you, they should probably have the lowest valuation. I think that's kind of the fair thing to do. For the investors that's coming in later stage, like, yes, they came in later when there's more proof, there's more things that's showing that your company is working. The valuation being higher is very defensible.
Yeah, and Elizabeth Yin, who we had on, has this awesome tranche strategy that we'll make sure to share back out with this content when we share back out, because I think it's exactly that. It's like, hey, I'm raising this much money, and the first 300K are going to get on this post at this valuation cap, and the next will be at this one. And that also helps drive people to make decisions faster and creates that sense of urgency and FOMO. So I think that's super smart. Let's talk about like, we talked about knowing how much ownership you have in your company today and in future rounds, like and I think we've talked about this before as well, but like, can you share just some general benchmarks on what I should expect for my pre-seed, seed, series A moving forward? Like how much the company is going to be diluted, all existing shareholders, so myself and founders, but like how much dilution the company's be taking every round?
So typically, like I would say 15 to 20% for your seed and series A rounds. So 15 to 20% each for both of these rounds. So you're looking at like 40% dilution by the time you hit the series A. So post series A, and this often surprises founders because what you've gone from, like, say you have two founders, you each own 100% of you each own 50% of the company where you're first getting started. After the series A, if you still own 40% of the company, that's considered really good. So where did all of this equity go? You have 40% that's locked up with investors, and you needed their capital in order to hire, actually build a product. That is very much the trade-off you're making. And then you probably have like another 15-ish% that's set aside for employees. You need to hire really good people to join your team. I think now more than ever, we've seen the importance of giving equity to employees. I'm actually of the mindset that I don't think you can actually hire great talent without giving them equity today, because the alternatives for anyone to work at a Facebook, Amazon, or Google is just far too high on the cash comp side. So what you're giving them today is like, let's give you an asset where you can own a small percentage of something that could become the next Stripe, that could become the next Facebook or Google. And that's the best way for you to actually compete, because you're not going to be able to compete on the cash comp side.
Yeah, the equity packages of those companies are insane too. It's just so hard.
It's never easy. And then the other thing I would say is, like, when you raise an equity round, like when it comes to employee equity, you're expected to top off the pool. The reason you also need to do that is where you're going to continue hiring. So like, say at the seed stage, you put aside like 15% in employee equity pool and you use like 10%. So now you're down to 5%. When you raise your Series A investor is going to ask you to increase the size of the pool by another 10%. So you have the equity available to give to employees to take you from A to B.
Yeah. Speaking of equity and options, let's talk about 409A, why it matters, how to get it, and really just give us your knowledge on all things 409A.
So what a 409A valuation does is it determines the price of options for private companies. So let's break that down. Like, why does that actually matter? If you're a public company giving equity to employees, you know what the price of your share is. Just look at the stock market. That's the price of the shares that people say is worth it. But if you're a private company, your shares aren't liquid. What are they actually worth? So what you need to do is do a 409A valuation in order to determine that. So a 409A valuation is different than the valuation of your company. When you're pitching the valuation of company, what you want to make the case for is like, this company is going to be worth a lot, and it's going to be really high. So for 409A valuation, what you actually want is to find a low but defensible valuation for your company and work with the 409A valuation auditor in order to determine that. So there's common stock and then there's preferred stock. Preferred stock is what investors receive, and common stock is what employees receive. So preferred stock often comes with preferences. It's called preferred because there's like almost like special bonus things with that stock. Some of the preferences can include like when a company gets acquired, investors get their money out first. That's called liquidation preference. Common stock doesn't have some of these preferences. And because it doesn't have some of these bonus points, you can make a case that the common stock is lower than preferred. So there's no rule of thumb for what is the 409A valuation determining the price of share for common compared to preferred, but typically like what we've seen is anywhere between like 20 to 30% of for what the 409A valuation comes back at.
What about you mentioned preferred stock? What if I've only raised safes?
So
how does that affect like 409A valuation, my employee stock, plan?
If you've raised on safes, you still need to be able to get so I would say like the specific IRS case, it's a little bit ambiguous, but almost all lawyers that we've talked to, almost all auditors have said, like, even if you raise on safes, you need to go and get a 409A valuation in order to give options to your employees. And you can calculate, like, you have a valuation from your safes. So you have that number. The way I would almost think about the 409A valuation is that it's what's the cost if you actually don't do it and the company ends up being really successful? The risk is that it can be harder for you to raise your next round. Oftentimes investors are asking, like, let's make sure that you dotted all the I's and checked off all the T's. 409A valuation is one of them, because there's a liability to the company if you're actually not doing it correctly and issuing options to your employees. B, I would actually say is if you raise some safes and for you to determine like what your 490 valuation price should be is actually fairly straightforward. Like for most of these companies, you're like pre-revenue. So it's also like a really quick thing to do to make sure that you're just doing it right. And because if you don't, and say in the worst case, you get audited by the IRS, what would happen is like if the IRS looks at like the price you issued shares and says, wait a minute, you have investors that saying your company is worth like $20 million, but you're issuing shares as if your company is worth like 500K. That's a little bit odd. Like they can actually go back and force your employees to pay the tax on the delta.
Yeah, just do it. It's super seamless on Pulley. So that's my advice there. That was awesome. We're gonna jump into Q&A, but just reminder, perks for both platforms visible in Pulley. Use Pulley 690, and then we're going to update this so you guys can get the redemption. If you want to use Pulley, we use it ourselves. It's awesome. The tool is great. The support's even better. So like if you write into support, you'll hear back like with well, I don't want to give any SLAs on your support. I just let's just say I hear back pretty quickly. Yeah, let's get into some questions that we've had coming in, and then we'll wrap up. And then thanks again so much for your time. All right, what's been the biggest thing you've learned going through YC 3 times?
Oh, that's such a good question. I would say it's different things each time. So the first time it's like drinking from a fire hose. I think the benefit of going through a program like YC is that there's so much pattern recognition. We've seen thousands of companies at this stage. And many of the questions that you have is like, it's just standard ones like, great, how do I pay people without it's working at my company? What should I worry about when I'm doing a SaaS agreement? And YC can help you just kind of get the basics right. I would actually say like maybe the part that I've actually learned from going through YC and starting a company like a few times is that nobody has the answers. So what I mean by that is like, if you talk to 3 people and they all tell you to do the same thing, you should just go and do it. That's clearly the right answer. But for most of the questions that you're actually going to have to deal with in running a company, no one's actually done it before. Like by definition, like if there's a company in your space that's similar to you, great. When they were starting, that company didn't exist. So you're very much like entering new territory. Believe in yourself. And it sounds trite to say, but I really believe in that because you're the one that's thinking about your company 24/7. Like any advice you get from someone else is going to be based on their past experience and them thinking about it for like a few minutes and then just giving you a response. So I'd say like believe in yourself because the company is going to really succeed or not based on the calls that you make. And it's far better for these calls to be something that you want to stand behind rather than you're doing what everyone else is telling you to do.
Yeah. This question was asked a couple times. And we may not be able to give an answer because I think it's one of those things like it's like it always depends. But maybe we can talk in generalities. So if post-money safes becoming more common, you know, and you're in the earliest stages, so you have a working prototype, you're raising from maybe angels, how? And we talked about getting comps, but like, are there any rough benchmarks for like post-money caps? And are discounts standard on safes as well? Like, and what are those typical discounts?
So so what I would say, okay, developer tools, SaaS companies tend to have higher valuations. It kind of is kind of like what the market is really excited about. I would say investors are more excited about businesses that have repeatable revenue streams and also are low cost to build. Hardware businesses, I think, are necessarily harder because you need to actually build a physical good. So valuations tend to be lower. Biotech companies is kind of binary. Lower valuations like pre-product concept, really high once you've hit it. So I would say like that's kind of the benchmarks that I would kind of give for how you think about it.
Yeah. Okay. We got a very technical question. We might not be able to answer this one on this call, but we're going to shoot for it. With respect to section 1202/1045, does that ring a bell to you, Yin?
I don't know what this is, so I think
okay. So all right,
yeah.
We'll come back to that one. We'll get back to you. We'll do a little research.
Yeah.
Cool. Let's wrap up with last one. Like, what have you learned about fundraising? And you've raised from some big names like Andreessen, General Catalyst, YC, I think Stripe more recently. Like any takeaways you've learned from raising from some of these bigger, well-known brand name investors?
Yeah, so we've talked a lot about like what are the terms that you want to raise on, but I think one of the questions that's missing is like who do you actually want to work with? If you think about like your investors are technically your boss, they're equity holders. Whoever holds equity within your company also decides like who's going to run the company in the long term once you have a board seat and everything. So I actually think this question of like who do you want to work with for your investors is really critical to answer. who I love raising from is oftentimes former founders, because they know what it's like to be in the trenches. From a numbers perspective, like if you're raising from a large fund at the seed stage, you're going to be a tiny percentage of their portfolio. Like they have to make the bet that your company is going to 10,000x to return the fund. So oftentimes when you're working with a big fund, they want to spend more time on companies they put in like $100 million, because those are kind of the returns where it starts getting serious. Like even if they put $1 million check, I think it ends up being a little bit harder for them to return the fund. So the reason I love working with former founders is, like, for an angel investor, if they're putting in their own money and say they think the company can like 4x, it still makes a tangible return. And those are the folks that we often get like the most practical advice. Like they've seen it done. It's not theoretical for them. They're former operators. They can give you advice on like how to do the things that you feel like are really scary. They can tell you what it's like to be in their shoes. And even more tactically, I would say the founders that's likely most useful for you is founders that are like 2 to 3 steps beyond where your company is. So like if you're going after a company that's at IPO, a little bit harder, because like for them, the lessons that they've learned are 10 years ago, not as relevant. But if you're a seed stage company, like go and get a founder that's at the series A or B, like they just went through the seed stage. So they can give you advice on how do you take it to the next level.
Yeah. Oh, I lied. That was awesome. One more question, then we'll go. Because it's a really good one. Where did I just had it? Okay. On a tactical level, can you talk about the strategies for managing the fundraising process itself? Should I manage it like a project, follow-ups? Like how should I think about managing my fundraising process at a very tactical, nuts and bolts level?
So the high level framework you should apply for this is that you want to get as much interest in as short of a time as possible. You want to create urgency within your fundraising process so you can get investors to close. Because this is why YC Demo Day works so well. It's founders and then a ton of investors. Investors know, like, if they don't put money in, the round may be over soon. So you want to create that urgency. What that means is for your fundraising, like make a list of all the investors that you think have and could be interesting for you to work with. They've invested in companies in your space, people that you can get in touch with. Figure out how you're going to get in touch with them. Intros are the best option. And then set aside a period of time, like 2 to 3 weeks, and then just go and take meetings with everyone and try to get the fundraising done. I would also say, like, when you're in the middle of fundraising, you likely will need someone else to keep pushing the company forward. It's really hard psychologically to shift from pitching to like going back and running the day-to-day of your business. So like know that the business may also slow down when you're in the fundraising mode.
Yeah, that was awesome. We'll make sure to include this as well. We just did a very tactical webinar, and just to reiterate everything you just said, we called it like the 1-3-1. So like spend a month building out your investor list, like who are the right investors for my business? How can I get introductions to them? Refining my pitch, putting my deck together, all of that good stuff. Get the prep going, because then rubber hits the road. Do all of your meetings in a 2 to 3 week span. That might take anywhere from, call it 1 to 3 months, depending on how hot your company is. And then there's always like the closing time, right? Like, all right, terms are set. It's always going to take 30 days for diligence, getting cash in, getting signatures, all of that good stuff. Maybe less if you're doing safes, but that's a really good question. And we'll wrap there. Again, always a pleasure. Thanks so much for spending your time and sharing your thoughts on all things with early stage fundraising. Founders, like, can't say enough good things about Pulley. We've been using it now pretty early on for the last at least a year and a half or so, and it's been an incredible tool. So check it out, and we'll see you all next time. Thanks so much.
Awesome. Thanks, Mike. Take care.
Yep. See you guys.